Yo, 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 it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today with another ADH wealth solution. Today, we'll begin to discuss fulfilling all of your financial needs. To contribute to channel growth, the links are in the description. To schedule an appointment of your own, or to purchase life insurance directly up to $1 million with no medical exam and an instant decision, my information is in the description. Lastly, make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. And now, here's our next feature. Salute, folks. It's your boy, the insurance junkie, your fiduciary fella, the all-star advisor Alonzo Hall, and I've returned today with another ADH wealth solution. Today, I want to talk about risk management, which has to deal with the common types of financial risk, how insurance addresses risks, and dealing with risks of loss. But before I go in, ladies and gentlemen, make sure you hit the like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule a one-on-one appointment with a licensed financial professional, the links are in the description. As we proceed to give you what you need. So, in the world of finance, aka the financial sphere, the word risk is synonymous with uncertainty. And that uncertainty is about whether a financial loss will happen. But even more importantly is the magnitude of that loss that the individual or the family might take. So now in our financial lives, we face two types of risks. There's speculative and pure. Now, speculative risk is where there's a potential for gain and a potential for loss. Think something like the stock market. But pure risk is when there's only a potential for loss. So I want you to think things like a car accident or an illness. Now, insurance is designed to address pure risk, not speculative. Now, designing risk as uncertainty is different from the typical definition of risk as odds or chance or probability. Now, it might seem slight, but the difference is actually major. For example, a 95% chance of something happening means that the risk is low. Now, on the flip side, this is why states run things like the lotto, as the chance that somebody hits and wins is a low risk. Now, risk management is handled in 4 basic steps. 1, identify exposures to risk and potential loss. 2, evaluate the potential losses that might result. 3, decide the best ways to handle the risk and the losses. And 4 is the implementation of a risk management plan. Now, there's also 5 ways of dealing with a loss. You can avoid it by not doing anything that would expose you to a loss, which, let's be honest, would be literally impossible. You can retain it by recognizing and accepting that certain risks are just a part of life. You can control it by using a process to reduce the frequency and the severity of losses. You can transfer it by contractually passing the loss from the one who doesn't want to suffer the loss to a party willing to take on the risk for a fee. A great example of this, you would think, would be insurance at first glance, right? But insurance actually does more. It actually reduces risk, which is the final way that you can handle loss. You can reduce the risk by making sure you'll be okay after a loss. So insurance reduces losses by having a large number of people that share in the financial losses that are suffered by a few members of the whole group. So it replaces an uncertain and potentially large financial loss with a certain but relatively small fee. That fee is called a premium. For example, would you rather pay $100 a month or $10,000 at once to get your car fixed after the old lady crashed into your car in the parking lot? So insurance operates through the law of large numbers. And the larger the group, the more risks can be reduced. Over the course of one's life, most people will own some, if not all, of the common types of insurance. The common types of insurance are health, life, disability, which I call paycheck insurance, and finally property and casualty, which is also known as stuff insurance, like your house and your car. Now, that's going to be it for today, folks. Make sure you hit the like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. With that being said, wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Salute. Hey folks, this last video was sponsored by my company, where we help people like you to reach their financial goals. We do this through a simple conversation where we help to identify and then protect your lifestyle, and then we implement a plan. The process starts at about an hour. So, if you want more information or you want to schedule a consult, contact me via the information in the description box, and let's talk and see if we're actually a great fit for each other. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge. Thank you, and enjoy life.